I will begin. Good afternoon, everyone in Israel. Good morning, those of you in the US. This is Phyllis Korf from Meir Brown, and we're very pleased to be doing a program with our friends from ERM. I'm sure all of you are aware of the situation that occurred late last week with Silicon Valley Bank and more recently with Signature Bank, and the resolution we had yesterday of the situation. So we'd like to continue our discussion here with some of our experts, and I'm pleased to introduce the Meir Brown team. First, Matt Bisanz, who is a member of our, I always trip over these words. This is a very long name, Financial Services Regulatory and Enforcement Group. That's why we call it FSRE at Meir Brown. So he is an expert on all bank regulatory issues. He's also vice chair of the American Bar Association Subcommittee on Banking Legislation and Regulation. And before that, he was vice chair of the Committee on Bank Enforcement and Troubled Institutions. Very relevant. He also has an accounting background. He's a CPA. And wait till you hear this. He has worked at the U.S. governmental agencies of the SEC, CFTC, DOJ, and I think most pertinently for this discussion, the FDIC. So hard to match both the experience and the expertise that Matt brings to bear here. And also we have Meir Dominitz from our banking and finance department, and Meir's practice is transactional. He works on acquisition and leverage finance transactions, syndicated and direct lending, asset-based, bridge financing, distressed financing, and complex management liability transactions. Meir and I have worked together, and it is a pleasure to be working with him again. And also with us is our associate Ziv Schwartz, who many of you in Israel know, and we are delighted to have with us at Meir Brown. And with that, Galit, I hand it over to you.
Thank you so much, Phyllis, and thank you everyone for joining today on this very relevant topic. We were very pleased to continue our relationship with Meir Brown and to join in this discussion about the different ways that the SVB, I guess what you could have called a crisis, and hopefully is already in the process of a resolution, but we'll let the real experts here comment on that, is proceeding and how it's affecting, I think, both the United States and Israel, the two probably most relevant markets at the moment, given the recent developments with SVB UK. So we are very happy to be participating in this talk and happy to be lending the Israeli side and perspective. I'm pleased to introduce Amnon Epstein, who is a founding partner of Epstein Rosenblum Maoz of ERM, our law firm here in Israel. Amnon heads ERM's finance and banking practice and acts regularly for a full spectrum of both lenders and borrowers, including Israel's leading banking institutions. Amnon also heads ERM's energy practice, and so he has a variety of experience in a few different fields that have really come into play most recently, and definitely over the last, I would say, 72 hours. And with that, I think we'll hand over to Matthew.
Yes, thank you. Thank you, Galit. Pleasure to meet all of you on this, and thank you for tuning in. I realize the time difference can be significant for people in Israel. So what is the current situation? Over on Friday, the U.S. government took possession of Silicon Valley Bank, and on Sunday, they took possession of Signature Bank. Silicon Valley Bank was the 16th largest bank in the United States, and Signature Bank was probably in the top 50 largest banks in the United States. This was done due to extreme pressure on both banks. There had been on Silicon Valley Bank on Thursday of last week, there had been $42 billion of withdrawals made from the bank relative to about $175 billion in total deposits. So almost 1/4 of the bank left the door in one day. The bank ended up on Friday morning owing the U.S. government over $900 million because it had overdrawn its account in the payment system. And so that created an insolvency situation that led to the seizure of the bank. Don't have all of the details on Signature Bank, but we understand there was a similar degree of pressure being applied to that bank. After the banks were seized, they are currently in what is called a bridge bank status. So there is a Silicon Valley Bridge Bank and there is a Signature Bridge Bank. These are U.S. government-owned banks. They have the full power and authority of a bank, and they contain all of the deposits, the insured and uninsured deposits of their predecessor banks, most of the assets of their predecessor banks, and all of the other obligations that you would expect. And in particular on Silicon Valley Bank, the U.S. government has disclosed that it has taken over the qualified financial contracts, so the hedging positions, the derivative positions, in-process securities transactions of Silicon Valley Bank. We are expecting a similar announcement to Signature Bank that those types of contracts are treated slightly differently, but we're expecting the U.S. government to take those over as well. And the way a bridge bank works in the United States is that the U.S. government operates the bridge bank for between up to 2 years. Typically, it's shorter than that, but they can go up to 2 years. And it is for the purpose of selling the bank to someone else. That, unlike some of the initial press reports indicated, the U.S. government has decided that it will try to sell Silicon Valley Bridge Bank and Signature Bridge Bank as going concerns to someone else. That there was, I understand, an FDIC auction on Sunday that may not have succeeded. And so the FDIC is remarketing these institutions primarily to large regional U.S. banks, but obviously anyone with money is welcome to bid. This is the FDIC's preferred approach because if it does not succeed in selling the bridge banks to someone, well, the problem is then the FDIC has to deal with all of the loans in these banks. It has to collect on the loans. It has to try to sell the loans in loan pools or other types of smaller asset transactions. And that just becomes an administrative nightmare for the FDIC. But to move beyond the structure of what's gone on, maybe talk about some of the products that you guys will be interested in. And so first, the FDIC has announced as part of a systemic risk determination, it was done in concert with Treasury Secretary Yellen and with President Biden, that all depositors of both banks will be made whole. This is exceptional. It required a determination that the failure to do this would affect the financial stability of the United States. It would pose a systemic risk to it. And so all depositors, both uninsured and insured, natural persons and corporations, all of those depositors will be made whole. There are a few, though, exceptions to this. It is only depositors of these banks that will be made whole. If someone has money at another part of these organizations, such as I understand there was a British bank that was owned by Silicon Valley Bank, and that is being resolved under British law, HSBC has acquired it, that bank would not be covered by the U.S. government guarantee. If there is money at a broker-dealer owned by these entities, that money would not be covered by this guarantee. The broker-dealers have not failed. They are not part of the bank. They are a separate legal entity. And so only deposits held at one of these two banks have failed. I understand that at least Silicon Valley Bank had a representative office in Israel. that office would not have booked its own transactions. So to the extent that someone had made a deposit in that office with Silicon Valley Bank in California, that should be insured. The one place we do not have full clarity on is there was a Cayman Island branch of Silicon Valley Bank that did take deposits. We do not know if those will be covered by the extended deposit insurance. My hunch is that they will, but again, that if you have deposits at the Cayman Island branch of Silicon Valley Bank, that is different than having them at the New York or California branches of Silicon Valley Bank. The flip side of deposits are loans, and a loan made by a failed bank remains a good loan. That if you have borrowed money from Silicon Valley Bank or Signature Bank, you still need to repay the loan in accordance with the terms of the loan document. They cannot accelerate the loan. They can't call the loan unless it's provided under the loan documents. You continue to mail in your payment or otherwise transfer the payment as you normally would. At some point, if they are unable to sell the banks, the FDIC may sell the loan on a loan-by-loan basis. And for those of you who are commercial or corporate borrowers, the big highlight here is that they can transfer the loan without your consent. And so typically in a large corporate loan, there will be consents of if there are co-lenders, or if you're the borrower on it, you may have to consent to transfer. And the FDIC has the power to override those consents. And so it can transfer the loan to anyone who is willing to pay for it. And at that point, you would need to begin making payments to the person who acquires the loan from the FDIC. The other part of lending that is important is commitments or letters of credit or lines of credit. And originally, we had expected the FDIC to cancel all of those. The FDIC has the power to cancel them. It has a minimal penalty to the US government for canceling those kinds of letters of credit. And at any point over the next, say, 90 days, the FDIC may cancel that. And so if you do have a letter of credit, a commitment, some other undrawn facility with one of these two banks, at some point you may get a letter saying it has been repudiated by the US government. But until that happens, you are free to continue to draw on it. You would follow the normal process to draw, and the normal repayment terms would apply. The next issue that I'll cover briefly is that under US law, as I think it probably has been made clear from what I've said so far, the FDIC has certain superpowers, like out of a Marvel comic. And some of the superpowers are that there is an automatic stay against people exercising rights that are adverse to the FDIC. And so if you have some kind of contract agreement with the FDIC other than a derivative or securities transaction, so if you have like a commercial lease, if you have a loan that you've made, that all of your rights are stayed for 90 days. There is an automatic stay during which you cannot exercise rights that are adverse to the FDIC. This is a bit of unfairness of US law, that the FDIC has the power to repudiate during those 90 days, but you can't do anything against them. And so you're kind of stuck hoping that they will continue to uphold their side of the deal, that they won't repudiate it because you are stuck performing on your side. And so if you have a loan covenant that says you need to send in financial statements, you should be sending in financial statements. If you have loan payments that you need to make, you should be sending those in. So that's part of the superpowers. The other one is a lot of commercial agreements have what we call defaulting lender or receivership terms, saying that if someone is placed into insolvency proceedings, if a receiver is appointed, if someone declares bankruptcy, that you automatically have certain rights. You can accelerate the agreement, you can terminate the agreement. We call those in the US ipso facto clauses, because it's by nature of occurring that and under US federal law, those clauses are void against the FDIC. So if effectively you have to treat Silicon Valley Bank or Signature Bank as if they were not in receivership, that you cannot terminate saying, well, they're a failed bank, obviously I can terminate a contract. That's not acceptable under US law. That if they don't pay, you can terminate for non-payment. If they don't perform, you can terminate for non-performance, but you cannot terminate solely by virtue of them entering into receivership proceedings. I've talked for a while now, and I should probably turn it over to our other illustrious presenters. But please, I'll be looking at the questions next.
Thank you so much. I think that we'll maybe move over now to Amnon to give us some perspective from the Israeli side of things. What I failed to mention earlier is just speaking as a partner here in the corporate and high tech group, that I think that the situation has really affected the Israeli tech market in particular, both from the VC side, the venture side, and from the company side, certainly from what we've been hearing over the last several days. And so it really is quite relevant to us as well. So please, Amnon.
Yeah, and just 1 minute. I don't think either one of us said this, Galit, but please put your questions in the Q&A or in the chat, and we'll try to deal with them. Thank you.
Okay, yes, thanks, Galit and Phyllis. I mean, of course, I think the questions from our participants are the most important. I mean, the Israeli angle, of course, is one of the angles, and of course, we're kind of in an Israeli discussion. At the end of the day, as Matthew explained, I mean, the Israeli subsidiary obviously is a service company. It's not a bank. No regulation apply to it, and the relevant aspect in its respect would be perhaps, in order to serve litigation documents. But apart from that, the Israeli entity isn't very interesting at all, because it doesn't hold deposits here in Israel, and just acted in some type of advisory role. By the way, during the last few days, they fired all their employees, as one would imagine, but the entity still exists as a legal entity. So as I said, in the context of serving litigation documents, should anyone choose to do so, I imagine under Israeli law that's a possibility, in order not to have to do service overseas in respect to any American entity. If someone wanted to bring a claim here in Israel, perhaps attach a lien, but again, there's probably no assets there anyway. And as I think Galit briefly touched upon, I mean, the last few days, the Israeli banks and obviously the various Israeli borrowers and depositors have been extremely busy. I mean, I in my nearly 25 years of experience of being a lawyer, I have never come across Israeli banks being so busy. So all the big names of Hapoalim, Leumi, Mizrahi, Discount, obviously through their US subsidiaries as well, have literally been working round the clock trying to come up with solutions. And I think the solutions are evolving, obviously, because I mean, the first need was to provide some type of bridge lending, just to be able, since in stage one, it seemed that, perhaps since the protection, the insurance would be only over up to $250,000. And in the case definitely of the Israeli public companies who are listed in the US, obviously even to pay salaries and rent or what have you, larger sums are needed. So bridge loans were put in place. We're talking up to 8 million or 30% of the deposits. Now, following the developments from today, and as Matthew clearly explained, I'm already hearing the Israeli banks are accordingly prepared, to see what happens, but basically provide much bigger bridge loans, of course. Matthew, you then touched on the whole matter of the existing revolving loans. From what I've managed to figure out, including with a few of our clients, it seemed that whereas the Israeli companies obviously have various outstanding loans, it seemed in most cases they were really partially utilized. Weren't used for kind of ongoing purposes, but rather only needed for M&A or some type of special needs. So in most cases, these monies were not needed. In any case, were not utilized, and therefore probably less a concern. And in most cases, the deposits are much more interesting. And as mentioned, now that we have for protection, it's more a matter of liquidity and how quickly the money will be, if you like, transferred back. With the exception of Cayman, as again Matthew mentioned them again. This is all what the feelings are on the Israeli side. That great, HSBC have stepped in the UK. In the UK, by the way, it's been a big issue as well. All the financial newspapers are discussing that as well. But Cayman, where quite a few Israelis, and interestingly, our Israeli participants know about this, but for the US participants, we're seeing in the last few weeks and a couple of months, Israelis are transferring money, private monies overseas because of feeling that they want to hedge their bets, if you like. And in quite a few cases, the decision fell on transferring private monies to Silicon Valley Bank because since the corporate monies were there, and in quite a few cases, very large amount of monies, at least for those individuals, went over to Cayman as opposed to the US itself. So there's quite a few individuals, perhaps also on this call, which are very much interested to see where this all turned out. Maybe as a final comment, obviously there are various legal issues which would arise, especially in the context of the loans. I mean, just a few things which could come up. I mean, one, in respect to the loans, Silicon Valley Bank, you may know, had a very nice withholding understanding with the Israeli tax authorities. So if indeed these loans get sold, the question is if the withholding percentage and what have you would be much higher, and a tax issue which would arise, and this could be quite an issue. A second point I think worth mentioning is the collateral package, because the Israeli banks, providing the bridge loans, obviously, I'm talking at the initial stage of, providing the loan up to 8 million or the 30%, wanted to take a collateral package, which involved also, taking charges, obviously, in Israel, but arguably also, catching perhaps a pledge over an account in the US. And some of the Silicon Valley Bank agreements had a very wide negative pledge clause, which means you're not allowed really to pledge or charge any asset of the borrower. And again, as Matthew, as you very clearly explained, this receivership is not, unfortunately, borrowers do not have covenants. And, as long, you can still loan and so on, we don't have a breach. And the Israeli banks were quite concerned whether they were not breaching the existing loan. At the end, most of them took a view that given the circumstances, let's charge what we can in Israel and hope to charge what we'll be able to in the US during the beginning of the week. And if we're in a breach of this, the Silicon Valley Bank documents, so be it, but we'll cope with it. Also based on general relationship, especially with the unicorn and the large Israeli companies. So I think those are the main points. That really last point is Benjamin Netanyahu announced that he's personally looking into how the Israeli government can assist there. There's been a special task for which has been put into place, and we have people from the Innovation Authority, from the Security Authority, and obviously from the Israeli Treasury, who are sitting today since the morning and trying to think what has been done. I understand again that the announcement that all deposits will probably be okay, which would be very helpful. Cayman may be an exception, and looking into perhaps providing some type of like the Israeli government did during COVID, some type of state-backed fund, which would help players who are not covered. So that's generally where we are from the Israeli side.
Okay. Thank you very much, Amnon. And Meir, let's hear from you on, anything you think that hasn't been covered that would be of interest to this audience.
Sure. Hello, everyone. Erev Tov to our friends in Israel, and good morning to those who are here in the States. I'm going to focus as a finance attorney, finance partner. I'm going to focus on some of the issues that have been raised and are being raised in relations to loan documents, credit agreements where Silicon Valley and or Signature Bank are either a lender and or the agent of the facility. We'll just qualify and hedge, and as was noted earlier, the situation is fluid and keeps changing, and of course some of the issues that were discussed yesterday are at this point moot in light of the creation of the bridge bank, and we will see and how things further evolve and change, and therefore impact those issues and create new issues. So with that being said, I think there are two categories. One is loan agreements where the failed banks were the agent, and the second is where the facility was agented by a different financial institution, and Silicon Valley and or Signature Bank are a lender. With the latter, it's a little bit easier because with the recent announcement that there's a bridge bank, and the bridge bank is going to honor all of the loan obligations of Silicon Valley. So companies can, for the time being, assume that the bridge bank will continue to make those loans and honor those obligations. The issue is that it raises more questions than answers at this point, is whether or not the new bank, this new bridge facility, is going to be treated as a defaulting lender, or whether that under the loan agreements, or whether that bank, the bridge bank, will be entitled to all of the rights and obligations that a new bank, that any other lender would have in the syndicate, such as voting, such as commitment fees and the like. Typically, under most credit agreements, including the typical formulation of the Silicon Valley loan agreement, the form loan agreement, any bank that for which a receivership was appointed to is automatically rendered a defaulting lender under the credit facility, regardless of whether or not the bank is funding and is honoring its lending and other obligations under the loan agreement. And therefore, as of putting aside the bridge facility, for example, as of this morning, Silicon Valley Bank was, for all intended purposes of loan agreements, was a defaulting lender, even if it were to continue honoring its obligations under the loan agreement. Therefore, it would not be entitled to the typical voting rights under most credit agreements, unless the matter that is up for a vote has a direct impact, adversely impacts the Silicon Valley as opposed to the other lenders, would not be entitled for a commitment fee under a revolver. But with the creation of the new bridge facility, the bridge bank, the question is whether this bridge bank is recognized as a brand new entity, which effectively acquired the existing commitments and or loans from Silicon Valley, and therefore it starts fresh, shall we say. Whether the bridge bank is really a successor in interest to Silicon Valley Bank, and therefore whatever the status that Silicon Valley Bank had as of this morning, that right in that status will transfer over. Logically, it doesn't seem right to penalize this new bridge facility that is stepping in to make things right, shall we say? But that is something that both companies as well as the agents under the various loan agreements will have to consider and decide. Another issue to keep in mind where Silicon Valley is a lender and or an agent is, notwithstanding the recent announcements, I suspect that many companies will rush to take out all of their all of their cash from a Silicon Valley Bank account, or shall we say at this point, this new bridge facility, because who knows what's going to happen tomorrow. That being said, under many of the Silicon Valley Bank, unlike Signature Bank, but the Silicon Valley Bank agreements, companies are required to maintain all or a portion of their cash in a Silicon Valley Bank account. And so, assuming, as was announced this morning, that the Bridge Bank will continue to honor all of the loan obligations and the loan agreements will continue to operate, companies should be mindful of that and not want to trigger an event of default and breach their own obligations under the credit agreements. So that's something to keep in mind as well. Shifting to the other category where Silicon Valley was an agent, it seems, at least to us, it's unclear whether or not the new bridge facility, that was not covered in the announcement by the FDIC, and it's unclear whether or not the new bridge bank will actually also become the new agent under those Silicon Valley Bank agented credit facilities, or whether the transfer of obligations from Silicon Valley to the new bridge facility is really limited to, in addition to deposits, limited to bilateral agreements between various corporate borrowers and the bank itself. Regardless of the outcome and whether or not the bridge facility will become the agent and those credit agreements will continue to operate. Again, there is a likelihood and understanding that many companies would like to find a new agent and replace this new bridge bank with a new agent, a different institution. The complication here is that under most credit agreements, the only way to replace an agent is with the consent of the resigning or replaced agent. And it may be hard to get. I have few clients who've been trying to get hold of Silicon Valley in the last 24, 36 hours. And as you can assume, it is very hard to get to them. And so what if you want to get a new agent in place as soon as possible? You just can't get hold of Silicon Valley Bank, or Silicon Valley Bank is not sure what to do at this point as well, whether they have the authority to resign and so on and so forth. It has been suggested that there's another mechanism under most credit agreements where you are not replacing the existing agent, but you are effecting an amendment with the consent of the majority of lenders to appoint an additional agent, or as we call it, supplemental agent, with that agent really taking over the duties and obligations of Silicon Valley as agent, effectively rendering Silicon Valley as an agent with the title, but no other real duties and obligations. For the time being, I do know of companies who are trying to borrow on Friday, as well as this morning. They're reaching out directly. In the case of where you have syndicated facilities with Silicon Valley being the agent, they're reaching out directly to the lenders, the members of the syndicate with the borrowing request. And our advice to our lenders' clients is to honor those obligations, those borrowing requests. The fact that Silicon Valley is or is not a defaulting lender under almost all, if not all, credit agreements, doesn't let the other banks off the hook, shall we say. Final point that relates to this is, and Amnon touched on this, it relates to the collateral as well. In the case where you want to transfer, where you want to appoint a new agent, thereby you will have to transfer the collateral from Silicon Valley, who's the existing agent, to the new lender, and that is of course something that can only be done with the consent and signatures of the failed banks, and that is of course a complication that adds to this fluid situation as to if and how one can appoint a new agent under those credit facilities.
Thank you, Mayor. Thank you very much. I think that was very, very helpful. We've received a question in the Q&A. I think this is for Matt, and that is, what if your assets are not in the bank, but in the broker-dealer subsidiary of the bank?
Sure. Thank you, Phyllis. And so the broker-dealer subsidiary, as you note, is a separate legal entity. And as of this morning, at least before I got on this, it had not entered into insolvency proceedings. That in the United States, the FDIC takes banks into receivership. Other types of legal entities have their own insolvency regimes. And so typically what we see is with prior failures is the bank would seize, the FDIC would seize the bank, and then the parent company and the other affiliates of the bank would enter into their own insolvency proceedings in U.S. bankruptcy court. That often is delayed by a few days because the pressure is greatest on the bank and the FDIC acts affirmatively, whereas it can take a few days or weeks for the obligations of the parent company to catch up. So far, the broker-dealer has not entered into insolvency proceedings. If it were to enter into insolvency proceedings, there is a special U.S. regime for the insolvency of broker-dealers. It is called SIPC, Security Investor Protection Corporation, and it provides partial insurance of positions at broker-dealers. It is similar to the idea of the FDIC's uninsured deposit or insured deposit accounts. It is not as absolute. The process is it's not as clean cut. You don't just get a check back automatically. There's a little more paperwork to it. But the treatment is that client assets at Silicon Valley Bank broker-dealer are still there. Presumably, you can transfer them out if you wanted to. You can trade with them. They belong to you. If they enter into insolvency, they would become subject to the bankruptcy estate, and they would be processed according to the SIPC priority and the SIPC insurance payments. And I wanted to touch on one other topic that we've been getting a lot of questions on, and it doesn't relate directly to Silicon Valley Bank and Signature Bank, but it is one to be considering when you are looking at other legal entities who you might have obligations to. It's called offset or set off. And this is the idea that if you have a loan from one of these banks and you have a deposit account at them, well, can't you just set off the loan with the deposit account and say, look, I had an uninsured deposit for $1 million. I don't want that back, though. Just don't make me pay the loan for $1 million. Let's cancel them out. And the FDIC, before they had put in place the bridge banks, had said that at least in some circumstances, they were willing to recognize set off at Silicon Valley Bank. This is a positive development. We don't know if they would do it at another bank if it were to fail. The two key points to it, though, are that the set off must be mutual, that if you have an account at the broker-dealer, if you have a loan from the broker-dealer, say a margin loan from the broker-dealer, and you have a deposit account at the bank, you can't set those off against each other, that it has to be a loan from the bank for a deposit account at the bank. And it has to be both have to be in your name. So if you have, say, a loan to your family office, your limited liability company, and then you have the deposit account in your name, that also doesn't work. It has to be a perfect match. And as people have been moving money around quickly in some of these dire situations, it's just something to keep in mind, that you don't want to end up with the failed bank having the loan in one entity under one name and the deposit account in another entity or under another name. And so that's something that we are cautioning people about as they are trying to quickly move money around. The other one is that as a fallout of the 2008 financial crisis, there arguably is a 90-day period before you can affect the set-off. And so during that 90-day period, you would need to keep making payments on your loan and otherwise performing. And then at the end of that 90-day period, you could recognize the set-off, tell the FDIC that you no longer owe them money because that you've given up your deposit account. That's setting off your loan. But you arguably under the 2010 changes, you have to wait that 90 days.
I'm just wondering, are there any lessons to be learned from this? Like have your loan amount in the same name as your deposit account? Sounds like one of them.
Yeah. So one of them that I think it was something that a lot of fintech companies probably haven't been dealing with is have a backup bank account. We've read all of the horror stories of people, particularly fintech companies and other startups, because they're new, they don't have extra bank accounts laying around. They only have the bank account that they opened when they started the company. And so we've had to read the horror stories of people transferring money into personal accounts, people trying to open accounts at foreign banks quickly. And in the United States, at least, it is cheap to maintain a bank account. That it can be a bit of a process to open one. I know that we have a lot of KYC requirements and all of that are painful. But again, keeping $1,000, $10,000 in a bank account at another bank, not particularly expensive, not a lot of paperwork. And gee, wow, wouldn't it have been nice if you could just automatically wire that money directly over? That's one thing. The other thing that a lot of people, a misconception that I've been hearing a lot about is they're saying, well, I had the account, it was in a custody account, or it was in an escrow account. I gave it to this intermediary who was holding it in escrow. And in the United States, it is almost impossible to segregate cash. That other than putting a piece of paper into a vault or somehow getting like a trustee at the bank to take the money, it's almost impossible to segregate cash. And so a lot of people in the United States and elsewhere, when they have large amounts of money that they don't need immediately, they put it into some kind of relatively safe asset like US Treasury bills, 30, 90-day Treasury bills, other types of super short-term obligations, securities that are government issued, government insured. And the reason they do that is because those assets, if they are, those assets will flow outside of most bankruptcy estates. And so if you had a Treasury bill with the bank, it sits outside the receivership, you just get it back. It's nice, it's a secured obligation. That's different than having a cash account at a bank. And so we often encourage clients to keep their excess cash in a type of safe securities account because that's more likely to go outside of the receivership and be protected.
Matthew.
Just an interesting point, tagging off of what you brought up now, Matthew, and I think also this was brought up both by you, Meir, and by you, Amnon, as well, but a differentiation, I think, or things that people have focused on in terms of how what has happened with SVB over the last several days has affected the Israeli tech community in general is the fact that a lot of Israeli tech companies were actually able to quickly divert their funds, at least those that had liquid assets within the regular deposit accounts, over to or back to their Israeli accounts in Israel. So I'm talking about the Israeli tech companies that were incorporated here, who held US subsidiaries and who opened accounts there, or vice versa. And that's actually, I think, the commentary on why many of these larger companies, eToro, for example, was really able to get those funds out as quickly as they could. And certainly our process of opening a bank account here in Israel is just as cumbersome, if not more so, than what you're experiencing there. So just an interesting comparison between, I think, how the community's been affected there and the community's been affected here.
And I think one point that we've been getting, and Meir probably knows this better than I do, is that there are some times where a bank will, as a condition of giving you a loan, compel you to move all of your deposit accounts to the bank. That is something I've been seeing in the press a lot. That was a standard term for Silicon Valley Bank, apparently. And if you agree to that, that's obviously your business judgment if you want to agree to it. I still would recommend, like you're saying, keeping another deposit account open, you don't have to keep money into it. Comply with the loan covenant, move your banking relationship over to the exclusive loan provider if you so choose, but do keep that extra bank account open.
Matthew, for the benefit of the participants, you had mentioned earlier KYC. Do you think that the new bridge bank will require KYC from the depositories?
That's highly unlikely. The way both the Bridge Bank Authority works and the way the USAML rules work for purchase and assumption transactions, there's almost no chance that they will require new KYC from existing customers.
Okay.
One thing, perhaps, well, again, obviously from the Israeli angle, is in Israel we don't have deposit insurance at all. One of the only serious OECD countries that don't have deposit insurance. Again, the assumption on the Israeli market, which has generally proved itself that Israeli government will always bail us out, but there's no deposit insurance. And I'm saying that in the context also that I can tell you this, I mean, it's kind of rumors that Israelis were especially good at getting money out on time. I mean, comparably to other nations and other depositors, they work quickly and cleverly, especially the VC funds, and they showed how quickly they can do that when the time comes. And going back to what's happening today in Israel, maybe interesting days ahead, but just something not so much in the context of Silicon Valley Bank, but generally, and perhaps finally for me as a minor comment, just to me, talking about the interesting point of having the necessity of approval of the agent and so on. And again, I mean, I've obviously got a very specific clarity, but from what I've heard also from other sources, at least with the Israeli players, most loans are bilateral loans, so they're not syndications. They're not even kind of with a preparation for syndication. So kind of concept of defaulting lenders are less relevant, and being obviously bilateral loans. So, but again, that's obviously just in the Israeli context.
And one thing to think about with the I'm glad to hear that so many people were able to get out under the wire, is that most banks publish the timing that they require each day for the cutoff for different types of transactions, and they can differ depending on the technique being used to send the money. So wire transfers may have a different cutoff time than ACH payments. International transactions may have a different cutoff time than domestic payments. And I'm just looking here at Silicon Valley Bank's website that, for example, if you were sending a wire in a foreign currency, so if you were converting it to shekels as part of it, the cutoff time is 1 p.m. But if you were sending an ACH in US dollars, the cutoff time was 7 p.m. And so that's a thing that when you are under the gun, like that 6 hours could have made a huge difference on Friday evening.
Interesting.
Okay, so I think seeing no more questions.
Phyllis, we can maybe suggest if someone wants to, there is an option to raise your hand. So if someone wants to raise their hand, we can allow them, I can allow them to talk and they can ask their question live. But if not.
Okay.
It was the intern time to discuss the winners and losers of the Oscars yesterday, which should really have been the conversation this morning.
And the gowns.
Of course. Of course.
Yes, and of course, it goes without saying that you can contact any of us by email, and we'd be happy to get the questions to the right person and answer your questions. So really thank you, Amnon and Galit, for cooperating with us and hosting this, and we look forward to doing other things together. And thank you to our audience for joining, And we look forward to discussing other topics with you.